Let's stay on the markets, talk a little bit more about the setup here as we look to wrap up this first real full week of earnings season, let's call it. We're joined now by Chief Global Strategist over at Deutsche Bank, Binky Chadha. Binky, great to have you back on the program. Thanks so much for jumping on. I want to start with a note that your team put out, which I wrote about a couple weeks ago, this idea of how fast the cycle is moving and these sectors of GDP that are now above their pre-crisis trend. And I'm just curious how you guys are thinking about what the future of this recovery looks like for markets, given the breadth of the recovery that we've seen across industries so far.
Yeah, I think, the key message that one wants to take away is that if you look at, very sort of broad aggregate measures of economic activity, and you look at, for example, GDP, which is probably the most popular measure of aggregate activity, you're going to conclude that in Q1, we were still about 1% short of sort of pre-COVID levels. And especially if you look, relative to the trend in GDP, because of course GDP grows over time, there's still a 4 percentage point gap, and that suggests that the recovery phase back up to trend has a ways to go, and of course the cycle doesn't end there. We go the other side of trend, and all of that suggests the recovery has much further to go. But what is very, very unusual this time around, and it's a function of really the speed and the composition of the recovery, something that doesn't happen 1, 2, 3, even 3 years into a recovery, is that various components of GDP, especially on the goods side and part of the investment side, are way the other side of trend. And so, what does this have to do with the equity markets? If you map the same kind of way of thinking about things or where we are relative to trend into 53 industries in the S&P 500, the somewhat surprising and rather loud conclusion is that about 2/3 of the S&P 500 by market cap is well above trend, and about half of that 2/3, so about 1/3 of the S&P 500 is actually, in terms of activity levels, is about 5 standard deviations above the trend level. Now, this doesn't mean that we're definitely going to roll over. It definitely does mean, though, that growth and earnings growth and activity levels are likely to slow. And what I would say, looking both bottom up and top down, the way that the market's priced currently is sort of that we are very much in the early stages of recovery. I mean, if you look at the multiple on the S&P 500, we're trading at sort of 24 times. It's normal for multiples to be high in the early stages of the recovery, but a deeper look at the industry level of the S&P 500 suggests that the bulk of it is actually much later, and multiples and valuations should be a lot lower. You can see that some parts of the S&P, especially the parts that are below trend, those that are basically sort of at trend, are discounting as the market normally does. And as you go above trend, the market puts a lower multiple on them. But for the market as a whole, I would argue earnings are already elevated, and the market's trading at elevated multiples on elevated earnings. So it's not a good combination going forward.
And there you saw the opening bell on this Friday morning on Wall Street. Exponential Fitness ringing the bell. They're the owners of Pure Barre, Rumble, and a whole lot of other fitness studios. Some of the top trending tickers on Yahoo Finance right now: Snap, really a blowout quarter. Facebook benefiting from the strong quarters from Snap and Twitter. Twitter, third trending ticker on Yahoo Finance. DiDi's still under pressure given a potential regulatory concerns. Intel, of course, too. Top trending ticker on the site right now post earnings. Binky, why, we came into the week, the market sold off aggressively. We've seen stocks rally back. Why do you think the market has come back as quick as it has?
So, we've argued for some time that you should basically look for a significant and bigger pullback as basically macro indicators of growth peak. It's what's happened basically in every recovery about a year in. And if you look at things like the ISMs, they have peaked. But what we've really seen is sort of the pullback on, or the reassessment of growth or where we are in this cycle. We've seen the pullback happen basically across asset classes, and really the S&P 500 and the Nasdaq have been the exceptions. And here I would argue that basically, the U.S. 10-year yield arguably basically overshot to the downside, and as it did that, it sort of impacted, tech, which was basically, pretty beat up. So that combination has sort of, seen us basically move back up. But I would argue, we are in the middle of earnings. Earnings, generally see basically the market go up by about 2%, and there's never really, we can go up by less, we can go up by more, but we've never really seen, a big pullback during earnings season, unless there was a clear sort of outside exogenous catalyst, like we had some time ago with Chinese devaluation and the like. But barring that, it's clearly earnings have been very, very supportive of the market, and we are in the thick of earnings season. And so it is currently still supportive, basically.
And Binky, how are you thinking about the Delta variant right now and its effect or lack thereof on your growth forecasts? I mean, it seems the data that we're getting is that vaccinated folks, they may get it, but they're not likely to be hospitalized or become severely ill. But we are, of course, seeing places that are pulling back on reopening. Is that going to have any effect on growth?
So it's another version of kind of what we've seen, where basically we've had this split between the goods side and the services side, and we're waiting basically for the services side to get further along, basically the reopening and recovery process. So that might slow some, but I would say as far as the good side is concerned, I mean, every lockdown has seen sort of a more modest negative impact. And so from a market point of view, I think that the market's going to continue basically to look through things. On the economic activity side, our economists basically see the risks, right now to the outlook as pretty balanced. Both, remember that for the last, several months, the main issue was really upside risk to the recovery, which is, as we talked about earlier, been happening much faster basically than most people expected. And so, some slowing in the cyclical trade, some pullback, like we've seen 10-year yields, many commodities. So I think, it has an impact on the composition rather than, a bigger impact on the activity of the markets.
All right, we'll leave it there. Binky Chadha, Chief Global Strategist and Head of Asset Allocation over at Deutsche Bank. Binky, always appreciate the time. Have a great rest of your summer. I know we'll talk soon.
We got to get back to earnings here. Back to the bread and butter. Snap and Twitter both out with numbers that beat estimates, as we talked about earlier. Snap shares trading at a record following robust numbers as well this morning. Both of those companies seeing subscriber growth, but Snap in particular also seeing better monetization of that subscriber growth, and both companies seeing fairly robust ad sales as well. Jason Helfstein is with us now. He's Oppenheimer Managing Director and Senior Analyst. Jason, it's good to see you. Let's start with Snap here and the growth that the company is seeing. And how are you thinking about them, sort of the transition to reopening? I see Snap as a company that people still use kind of when they walk around just to text, even if they aren't posting the same kinds of things on Snap that they were doing before.
Yeah, I mean, look, just numbers real quick. They added 12 million users in the quarter. That was less than first quarter 16. So you could argue maybe the reopening kind of had them adding less users, but it was 3 million above where they guided. They did make a point of talking about they think with the reopening, you potentially get less kind of user-generated content created. And so as opposed to Spotlight, which is kind of more of the, the kind of semi-professional, right, of kind of influencer content. So look, definitely in the narrative, but I think the more important thing here is that they really are dialed into what the advertisers are looking for. And as, again, brands feel comfortable about the economy, are launching new products, they are looking at Snapchat as a key platform for them, and especially going to the kind of all-important, back to school holiday season, it looks like Snap is incredibly well positioned and kind of leading with these augmented reality and kind of next generation advertising.
And Jason, thinking about Snap's place within the online ad ecosystem, is this a story of Snap gaining share within that, or is it just that Snap continues to offer such a compelling platform on its own that it's bringing in spend even if its share relative to a Facebook or a Google isn't climbing at a rapid rate?
Yeah, no, they're definitely gaining share. I mean, they were up, their revenue was up 116%. I don't think any other company in digital media will see that much revenue growth in the quarter. I mean, Twitter was up, which we'll talk about in a minute, was up 74. I think people expect, again, kind of Facebook and Alphabet to be strong, but not nearly those levels. So no, they are, on paper, they are gaining share. And then kind of you talk to advertisers, they are gaining share of mind with the products that they're talking about. And again, a lot of what they're talking to advertisers about, no one's really spending money on yet, like, virtual try-on ads and, but people see where this could potentially go. And so, right now they've kind of having the best of both worlds, which is that on paper they're gaining share, and the enthusiasm around what they're doing. And then look, I mean, we all sit around thinking about, well, we don't sit around, but when we think about these companies, we're always thinking about like, what is like the next leg of growth? Like, is there another business, another vertical that has not been factored into the model that you'd say if they did X, it would be worth Y, and the stock is not as expensive as it appears on paper. And so now there's a whole discussion of like the metaverse, right? And you report on kind of what's going on in the gaming space and Roblox and all that, and Mark Zuckerberg has talked about it in this idea of like, could Snapchat be a player in the metaverse? Well, what they're doing with augmented reality, they have the audience, maybe, right? And so those things just get Wall Street really excited.
Jason, what's this better stock to own, Twitter or Snap?
I mean, from here, it's easier to say you'll make more money in Twitter. Snap, expectations are sky high. I honestly think people are surprised that the stock is up this much. I mean, if you talk to, institutional investors, they expected a very big quarter and very big guidance. And honestly, while the guidance is great for the third quarter, guiding to kind of 59% revenue growth at the midpoint, call it 60. Most of the institutional investors were expecting that. So I actually think you could see much more positive surprise in Twitter over the next 12 to 18 months than Snapchat from a kind of financial standpoint.
And so maybe moving, staying on Twitter, but moving away from the financials specifically and thinking about the product pipeline that we've seen from Twitter over the last, quarter. They called out in the letter, they've got ticketed spaces, they've got super follows now. As an analyst covering the company, how does that product cadence, animate anything for you? Does it make you think differently maybe about, how management's running that business?
I mean, a few things, right? So the whole issue that Twitter had historically was it was too hard to use. So people went to Twitter and then they didn't go back because they didn't know what to follow. It's too confusing. And so I think topics is huge. It makes it much easier for new users. They talked about adding 2,500 new topics. They're now at 9,500 topics across 9 languages. They're doing, they had 175,000 new city locations. So they're now, and kind of cited the benefits of that. And so I think you're just seeing kind of better kind of engagement with, the new incremental users. And then the idea around the Olympics, there will be a lot of people who come to Twitter who probably have not been on Twitter in 2 years, right? Since the last Olympics or maybe some sporting event, some championship sporting event or something. And to the extent that Twitter is a better experience now than perhaps the last time they were there for a major event, that increases the likelihood of repeat activity. And so I think that's really where it all comes together. I mean, yes, it'd be terrific if they can get the subscription product out. And to your point, tip jar, ticketed spaces, super followers, all that. But, at the end of the day, Wall Street is very focused on, DAU growth and revenue per DAU. And so, that's the output, right? So it looks like, for the first time in a while, Twitter is really doing the right things and look, we are in a very momentum-oriented stock market, so you could understand like why Snapchat is seeing the kind of activity it's seeing today in the stock. But I think kind of as the dust settles out, I think you'll get investors kind of looking at Twitter, and some people who may have not invested in Twitter in a while coming back and saying, okay, this is becoming much more investable.
Hey, Jason, just one last quick one on Bitcoin, which is something that Dorsey was asked about on the call. And obviously, he's really leaned into Bitcoin and his other business, Square. It's a more natural fit. And he sort of talked about Bitcoin for Twitter, but it's unclear to me what exactly it brings to the table. Do you think there is an opportunity here for him to sort of integrate it more into the Twitter business also in some way?
I mean, look, I think he's trying to be, supportive of Bitcoin to the extent that he's trying to figure out like real business applications for it. I mean, to the extent that, payments or virtual gifting becomes more prevalent in Twitter, technically you could accept Bitcoin, but I kind of don't see Twitter becoming a Bitcoin play anytime soon.
Gotcha. One of the few things, I guess, that he's touched that it maybe isn't as much. Jason Helfstein, thank you. Oppenheimer Managing Director and Senior Analyst joining us there to chat what's going on with Bitcoin.
All right, beautiful weekend incoming here in the New York City area. I will certainly be out with the new Weber Genesis, getting after it with some burgers and dogs. Joining us now to talk more about the grilling season and really just the, we could do puns on this all day, but we can't get around the hot grilling market right now. We're joined by BBQGuys CEO Russ Wheeler, company set to go public via a SPAC combination with Velocity Acquisition Corp. Russ, thanks so much for jumping on this morning. Congratulations on the deal. Let's just start with some of the financials here. We love to have SPACs on that are making money, top and bottom line. Guys grew 70% in 2020. Talk a little bit about the trajectory of the business as we've gotten into 2021, where demand for outdoor living, as your company certainly knows, remains quite high.
Well, thanks, Myles, for having me. It's good to be here today. As you said, 2020 was a great year for us. We saw a lot of growth, and we had good, strong demand heading into 21 as well. So we're seeing that the business continues to accelerate, and that while there was a COVID bump, we certainly think that these tailwinds are here to stay.
Russ, I was surfing around the internet. I can't seem to find a site that does and looks exactly what you do. Who do you think some of your competitors are?
Well, Brian, you make a very good point, because we really are kind of unique in this specialty space. We're the category experts for everything you need for outdoor living. So that's the opportunity we have. We really try to help the customer with whatever they're looking for. And we like to say we sell projects, not products. And so when you come into our ecosystem, we can help you from everything from upgrading your grill, like your Weber Genesis you were talking about, or we can do a complete online outdoor kitchen design and really solve it. So when you look at, companies like Home Depot, Wayfair, Lowe's, Amazon, they're all great companies, but we certainly don't try to beat them at what they're good at. We really try to stick to what we're good at, is really giving this solution.
Yeah, and Russ, I wanted to talk a little bit more about the relationship that you have with a couple of these other brands. Of course, we know that Weber and Traeger are both set to go public on their own, and there's been a lot of talk about their products and just what your relationship is as a middleman of sorts. You guys have your own grills, but certainly you seem more than happy to play nice with everybody who's in the space right now.
Great. That's a great way of putting it. We certainly do play nice. They're great brand partners of ours, and we're Weber's and Traeger are two of our best brands. We're thrilled about all the excitement around the category, with Weber and Traeger both coming out. Same with us. So we just think that just puts more excitement around the category. There's a Weber right there.
Hey, Russ, it's Julie here. I want to ask about the history of the company a little bit, because it's fascinating to me that this was a bricks and mortar retailer originally down in Baton Rouge, and you guys are online only pretty much now, right? You don't have stores anymore. And it seemed like you guys were sort of on the early wave of that kind of transition. What drove that?
Hi, Julie. Yeah. So we started about 20 years ago in Baton Rouge as a brick and mortar, barbecue store. And what we did is, over the years, early in 2000, we launched our first website, and then our first own brand in 2013, which is Blaze, which is a higher end gas grill. So as we continue to evolve, we still do have our showroom in Baton Rouge. So, and the way we know that's really good is because when you look at our sales by state, Baton Rouge or Louisiana always over-penetrates. And we're going to be testing that in Atlanta as well. We're going to be opening a design center in Atlanta for our professional customers. When we say professional, we're talking about, custom builders, remodelers, interior designers and architects. We're going to have a design center in Atlanta to go after the Atlanta professional market, similar to what we've done and continue to do in our Baton Rouge headquarters.
Russ, coming into the segment, Julie voiced some potential concern around tong shortages. Are you seeing? Are you seeing shortages in tongs? You name it right now.
Not in accessories. There's certainly supply chain challenges, just like, you earlier with Whirlpool. And, I know that brand from my old days at Build. The supply chain has been challenging for sure, but we were fortunate. Q3 and Q4 of 20, we were very aggressive in our inventory, which allowed us to really roll into 21 in a good position. In February, March, it kind of got tight. It's kind of the worst months, but we're starting to see, whether you call it the new normal for supply chain, product is flowing through the supply chain. And, Whirlpool saying the prices are going up, and you were talking about that as well. The prices are going up with stainless steel and other things. But again, people are more interested in getting it quick, like you were talking about with your dishwasher, than, paying 5% more for it. So we're not seeing it hurt the demand any. And we think it'll start to loosen up, in 22 with all this additional capacity that's being built, and it'll be coming on.
Yeah, Russ, I'll say I was quite lucky. I was in a mom and pop hardware store. They had a fully assembled Weber. They had like two, and I just took the one that was already assembled. Otherwise, I'd probably still be waiting for that. I want to switch gears a little bit and talk about some news that came out right before the SPAC announcement. As a Giants fan, had to notice working with the Manning family. Just want to talk a little bit about the work you guys are doing with them and how you think about pulling the levers on marketing now that you're going public. You've seen a lot of growth, and it's a growing category, and how you think about ways that you can build your brand within that.
Well, first we want to grow our brand profitably. So we've always been we had really strong growth, but it's really strong profitable growth. So the partnership with the Mannings is really great. They were investors in the company from the beginning. So they've been with us since we started this journey, well over a year ago. And then they evolved into brand ambassadors, and they really fit our brand well. They're from Louisiana, from New Orleans. We have deep Louisiana roots, and it's about family. Barbecue and outdoor living is about family, friends, and creating memories. And there just couldn't be a better partner than the Mannings and Eli. They're so genuine and authentic. What you see is really that. So as we start to do these brand building campaigns, we launched the one you just showed there, Born to Grill. We've had a lot of excitement around that, and we just actually filmed our last commercial in New Orleans with the whole Manning family. So now. Peyton and Cooper are joining. We had Archie and Eli first, but we're going to have all the brothers and Archie in our next campaign that's going to be launching heading into football season, which we're really excited about the fall.
Russ, help investors get to know you. Are you one that is likely to grill up a Beyond Meat burger or a tomahawk steak, and why are you in this industry?
Well, first of all, the industry is incredibly fun. We have a fantastic team. Again, we built a business in Baton Rouge, Louisiana, and when we say we have these category experts that can help you, when we're training, we do something called PGT, which is paid grilling time. So when you're training, we're getting you out there on the grills, and our folks that are really the pit masters, and I'm not a pit master, they're teaching you how the grills, like what is this? What is a Weber gas grill? What does a Traeger pellet grill do? What is a Kamado Joe, ceramic? So they're really getting educated so they can really help the customers what they're doing, but we have a lot of fun along the way. And, I like a little bit of everything. We do have tomahawks. We actually launched our new consumables program. So we selling high-end proteins, everything from tomahawks to fillets to what we're calling battle boxes. The battle box, I actually have one just come in that we're going to grill this weekend. It's like Wagyu beef patties. It's steakhouse burgers and bison. So we're going to, we'll have a little cook-off with those this weekend.
Yeah, a little bit of a Mountain West feel for you guys as we head into this weekend. Russ, I got a great job. I sit here, I ask questions, interesting people like you. I need to find how to get some paid grilling time into this thing because
come down to Baton Rouge, we'll hook you up.
That's right. I am not doing enough to get the consumption going on this desk as well. All right, we'll leave it there. Russ Wheeler, CEO of BBQGuys. Russ, appreciate the time this morning. I know we'll be in touch as you guys go through your merger process.
Well, Tesla and Elon Musk might still be waiting to return to accepting Bitcoin as a form of payment again for Teslas, but exactly the opposite is playing out right now in the medical field. Doctors are increasingly accepting crypto as a form of payment for everything from beauty products to medical procedures. Yes, even accepting Bitcoin for Botox. And for more on that trend, happy to bring on Dr. Norman Rowe, a board-certified plastic surgeon in New York, who also now accepts Bitcoin. And Doctor, for starters, I guess how did this all come about? What sparked the call to start accepting Bitcoin over cash?
First of all, thank you both for having me. Sorry about that. Thank you both for having me on your show. I'm very excited. I love your show, by the way. Why did we start? It was overwhelming demand. I mean, it's kind of the same way that Elon Musk, not that I'm comparing myself to Elon Musk, but there was a need. And so we filled it. We had patients who asked, we take credit card checks, cash, whatever, and they asked you to take Bitcoin. So we obliged them and said, yeah, it's convenient for us. It's convenient for them. And we have to stay there. So so we offer it to our patients and give it to them, and it was overwhelming demand, and we gave it to them.
And so if you break down what the forms of payment right now for the services you offer, what percentage would you say is in crypto?
5 to 10%.
And when you talk about the demand, 5 to 10%, obviously you see much more demand going on the back of that. So how significant do you think the upside is?
I think that the upside is going to go nowhere but up. It's going to do nothing but increase. If you think about it, look what happened just a couple days ago with, or just yesterday with Elon Musk. I said, there was actually a podcast where some of economists were saying that eventually the Bitcoin is going to be the same, cash basis as the U.S. Economy. And so, if you believe that, then there's a tremendous amount of upside and growth for Bitcoin. I think it's a future of commerce, and I think that we wanted to get on board sooner rather than later.
Yeah, and Dr. Rowe, we've talked about how companies are starting to do more of this, and it sounds like you're using Coinbase Commerce to work through and accepting crypto. They also added Dogecoin to the amount of cryptocurrencies that they process for transactions. Is it just Bitcoin you're accepting, and how do you look at maybe potentially accepting others out there?
Right now, we're accepting Bitcoin and Ethereum. Doge, we're looking into it. I'm not going to say it's a little bit more volatile. It's just a little bit more of an unknown. And also, at the end of the day, I have to protect the practice. So I have to make sure that there is an upside to whatever crypto that we're accepting. And I think there's a little bit more, I'm not going to say stability, because there's a tremendous amount of inherent instability in crypto. But I think given the fact that, Bitcoin has a certain endpoint, that they're only making 21 million coins, and, there's a certain finite amount, not so much Ether, but in Bitcoin. And I think that lends a little bit to its credibility, which helps me more so than the Doge and even Ethereum.
And Doctor, for all the demand that's there's also an equal amount of volatility that comes with holding crypto. As a business, how do you protect yourself against some of those price fluctuations?
Well, initially we were hanging on and keeping the transactions in Bitcoin and keeping them in crypto. Now, in order to protect and hedge, we're basically cashing out and converting to dollars about half of the money in Bitcoin. I'm leaving half in crypto. So we're protecting against volatility by cashing out. And what we do, and the way we're doing it, it's roughly half. That's because our markup is about roughly 75 to 80%. So I'm cashing out and taking out whatever I've invested in the procedure that the patient wants. And the thing I leave, quote unquote, ride is the profit. And so I'm cashing out on my expenses, and the rest I leave in crypto.
Interesting approach. Interesting. It's going to be interesting to see if more doctors start to do what you're doing there. But Dr. Norman Rowe, board certified plastic surgeon, the first to catch on here. Appreciate you coming on to explain it all to us. Be well.
Well, in the past 2 weeks, not one, but 2 billionaire businessmen have gone to space, paving the way for the ultra wealthy to become astronauts in the future. But our next guest says that if you plan to buy a seat on a rocket ship, expect to pay a tax. We're joined now by Oregon Congressman Earl Blumenauer and Chief Political Correspondent Jessica Smith. Congressman, great to have you here with us. So I do want to start with that tax. Who would have to pay it? And is it for space tourism only, or is it going to be for all new space exploration that we're going to see coming down the pike?
This would be a tax simply on space tourism. It doesn't impact people who are working on research projects, but it is if you buy an airline ticket to take your family to Legoland, you pay a tax. And just because people are billionaires and they're going into space, I think they too should be able to help support the nation's infrastructure needs. Space travel, after all, would not have been possible without hundreds of billions of dollars of federal investment. And I think treating them just like we would treat other tourists makes sense and helps us deal with our infrastructure needs.
Hi, Congressman Jessica Smith here. Wondering if you can talk about what you'd like to see this revenue that gets brought in used for. Do you have specific ideas in mind? I know you've been concerned about the climate impact of all of this.
Well, to be sure, the estimates are that a space launch accounts for 60 times greater emissions than transatlantic flights on a per passenger basis, enough to drive a car all the way around the Earth. It might well have an opportunity to help us on efforts to mitigate climate impacts, but also infrastructure. We're in the process of trying to figure out how we provide the money to rebuild and renew America. Clearly, we're on the edge of something that's going to grow exponentially and over time. There are hundreds and hundreds of people who've signed up to pay rather extraordinary, expensive tickets to be in space for a couple of minutes. I think we ought to get ahead of the curve, have resources to help rebuild and renew America, and perhaps mitigate the environmental impact.
I'm curious if you've had conversations with your colleagues on the other side of the aisle. We've seen them be very hesitant, resistant to raising taxes at all. Have you had any conversations with them about this?
We just started this last week. I anticipate having conversations with our Ways and Means Committee members who would be involved with tax matters, and also with the Transportation and Infrastructure Committee. I've gotten some feedback from the leadership of that committee who think it's a good idea. And they see what happens with airline traffic that is taxed. And they think as we move into this new realm of space tourism, it makes sense.
Congressman, I want to ask you about some of the regulatory issues, and we've seen a lot of concerns, at least just recently, with the FAA and companies like Boeing, for example. What kind of expansions do you think are really going to need to be made to the FAA so that we can really handle space tourism more safely and obviously more commercially going forward?
Well, we're just scratching the surface here. There is clearly a demand. There are several companies that want to be involved with it. And we're entering into a new era in terms of space activities. There's lots of private satellites being launched. There's great interest in space tourism. Others want to have space stations. There's going to be a responsibility for the federal government to regulate this. So everything from space junk to space congestion and safety. We're just scratching the surface now, but regardless, it seems to me clear that it's going to require some money to do it right. And I think taxing like we would if they were going to Disney World makes sense.
What's the timeline on this? When are you hoping to actually get this proposal finalized? And then eventually, what's the timeline to get this passed?
Yeah, well, we've started circulating proposals. I'm having a meeting soon with people. And I didn't realize how many people have been involved with these areas who have ideas about how it should happen. So we're going to talk it through, have people comment on opportunities, challenges, different ways of levying a tax. And there's talk of a two-tiered system for different length of trips. It's not going to be something that's going to happen anytime soon. I anticipate getting this out, drafting the legislation, being able for people to critique it, but there will be more infrastructure legislation that's going to happen later in the fall, and I'd like something ready if legislation starts to move that we could incorporate it.
I do want to ask if there is going to be plans to funnel any of this tax revenue, from the space tourism, perhaps to American space exploration, to NASA, to aerospace research, or do you think it's just going to essentially join the pot for the budget?
Well, we have lots of expenses that are going to be incurred, as I mentioned, some of the challenges in terms of space congestion, space safety, space junk. Having the tax, making it available for our infrastructure needs, I think is fine if people want to particularize it. But I see this as entirely separate from what we do with NASA and activities for our own research and space activities. This is just space tourism. And it's, as I say, it's just like people going to Disneyland pay a tax. People who are going to go up in space pay extraordinary amounts of money for a few minutes of weightlessness. There's no reason they shouldn't pay as well.
All right, we'll have to leave that there. Congressman Earl Blumenauer from Oregon, Chief Political Correspondent Jessica Smith, thank you both for joining us today. Welcome back. Well, GM is shutting down most of its pickup production for a week, thanks to chip shortages that continue to weigh on automakers right now. We're joined now by Garrett Nelson, Senior Equity Analyst at CFRA Research. Garrett, always great to have you here with us. So pickup trucks are really the best sellers for car makers. GM is no exception. What kind of hit do you think revenue-wise this is going to bring to GM for them to halt most of their pickup truck production for a week?
Sure, thanks for having me. Well, that's what they're saying. It's just going to be for a week, but in our view, it could extend well beyond a week, and it really hurts GM because at the plant that they are idling production in Fort Wayne, Indiana, it produces their two best-selling vehicle models so far this year, which are the Chevy Silverado pickup truck and also the GMC Sierra. So, those vehicles are highly profitable. They really move the needle on the bottom line for GM. So this really hurts. And I think the investor perception has been, GM is doing a better job navigating these semiconductor chip shortages than other automakers. For example, GM's US vehicle sales volume was up 40% in the second quarter. Compare that to Ford, which was only up 10%. So GM had been doing a better job, but I think now the reality is that there are things beyond their control, and they just can't seem to get the chips to produce those vehicles, and so really it's an all hands on deck type situation for both for GM and other automakers. They really need to ramp up their production and kind of ameliorate these supply issues which have been plaguing them. Which looks like will extend, well into the second half of this year, perhaps well into 2022 and maybe beyond.
All right, Garrett, you bring up a couple of issues here, and I want to get to some of the other automakers in just a moment. But looking at GM, you're saying that this could last much longer than a week. Curious to know how much longer past the week, or are you guys estimating this might go? And if it does just last the week, are you imagining that perhaps we're going to see repeatedly throughout the remainder of the year GM coming out and saying that they're going to have to idle production in some of their factories, that this is essentially just the beginning of a long cycle of pausing and restarting that production thanks to these chip shortages?
Well, I think we have to take GM at their word for now. So we're only assuming that plant is down for a week, but the reality is we think there's a very good chance it could extend well beyond a week. And we don't think GM's announcement was the last we've seen from the major automakers. We think there are more announcements to come. And it's really weighed on the stock price performance over the last month or so, because in mid-June, they came out and they guided for much better than expected second quarter. And so there was really a feeling that maybe these issues were getting better, but now it's become clear that the issues are maybe worse than was thought, in mid-June. So I think that's what's really weighed on the stock price. And, as I mentioned, it really hurts GM because these are such higher margin vehicles. And in fact, they're diverting some of their chips from some of the lower margin vehicles so they can keep producing some of the higher margin vehicles. So, we'll see what happens from here.
Now, you've mentioned other automakers and that they might take similar action. We know that Toyota actually stockpiled chips and for the first time was actually able to beat out GM, at least when it comes to car sales, thanks to that stockpile. But as you're mentioning, Ford not doing as well, at least when compared to GM. Are you imagining that we're going to hear Ford next, perhaps making a similar announcement? And after Ford, what automaker are you looking at that you're saying these guys are also really struggling? If GM needs to idle, so do they.
So Ford has made such announcements, and it's really impacted their production and sales so far this year. I think what's changed is really, a view that this is going to continue, well beyond the first half of the year, and it could take several months or several quarters to really work out. These companies are sitting on very, very low inventory levels. If you go to dealerships, there's not a lot of inventory right now. In fact, inventory levels are at record lows, and it starts to really hit the bottom line of these companies. So, we're very bearish in the near term as far as the ability for these companies to ramp back up and get back to the production capacity utilization levels that they were running at before the pandemic.
It's also hitting the pockets of consumers that are out there trying to buy used cars and new cars. We've seen a lot of those prices spiking lately. Do you imagine that there's going to be further price hikes, at least for some of these vehicles going forward, as the shortages really continue to weigh on those automakers? Again, as you mentioned, into 2023 perhaps, into 2022. And we heard already from Intel CEO saying that these chip shortages are going to last into 2023.
So there's no question there's been a lot of upward pressure on pricing for both new vehicles and used vehicles. That upward momentum will probably continue in the near term. So, but really looking out 6 months or so, the supply demand situation becomes much less clear. So we can really only have visibility at this point, through the end of the year, and we'll have to, reevaluate how things look, at the end of this year. But certainly inventories are an issue because there's hardly any availability. Pricing has been moving higher. It will continue to move higher, we think, and that's also supported by some of the stimulus. You have the supplemental unemployment checks, which will continue until about Labor Day, and also the child tax credit payments, which is a form of stimulus for U.S. consumers. So you're putting all this cash in consumers' pockets, and that's helping drive up, the pricing of autos and many other products, as we know. So, we see that continued upward pressure on pricing in the auto market, for the next several months.
All right, Garrett Nelson, Senior Equity Analyst at CFRA Research. Thanks so much for stopping by.
I want to throw some statistics at you. This is according to our next guest. There are 4 billion buildings and 20 billion spaces worldwide. Quote, the built world is the largest undisrupted market with less than 1% digitized. But there is now a company trading publicly as of today that's going to tap into this this is the figure, $230 trillion worth of global real estate. Let's welcome into the stream RJ Pittman, Matterport CEO. And RJ, there is certainly a huge market out there to tap, but let me just describe it this way. What you do is the cool thing. If I want to go look at something, then imagine what stuff would look like, you digitize the space, which allows me to then interact. I don't have to go, right?
Exactly right. We digitize all kinds of buildings and spaces, from homes to hotels, high rises, office spaces, factory floors. We've been Matterporting for 10 years, and we have buildings digitized in over 150 countries, and millions of buildings and spaces have been Matterported. But as you said, it's just the starting point against that massive opportunity of over 4 billion buildings.
Yeah, RJ, talking to us about the expansion opportunity here, or really the runway for your company to grow. Now that you are a publicly traded company, I guess, what kind of advantage do you think this gives you now against some of your competitors or some of the other players in this space?
Sure. Well, as I mentioned, we are the first mover and we're the category leader in this space, and we've largely defined the category that has set us up for tremendous success. So we have been honing the technology, perfecting product market fit across a number of big verticals, including the enterprise. Some of our most exciting companies today are coming in from the Fortune 1000 onto the Matterport platform. And these are some of the largest real estate companies in the world and some of the largest technology companies in the world that have huge swaths of real estate that they all want digitized for just about everything, from construction planning or space planning to come back to work post-COVID. Or in the case of a hotel, to be able to promote it in such an immersive way that the future guests actually get a feel for what it's like to actually be there before they book a room or book a vacation.
Where do you find resistance, though? Because there are competitors out there. You mentioned that you're the first, but it seems as if there's still a long runway just for you to run.
There's no question. And look, because of the advantage we have, we're the only company out there that, first of all, can create these digital twins automatically. This is all done in AI. It's a data science problem that's made it hard for other companies to scale to our magnitude. I mean, to put it in perspective, we're digitizing and creating digital twins to the order of about 250,000 buildings and spaces every month. And we have the capacity now to take that up to the millions of spaces per month. And part of this transaction represents two things. I mean, clear validation for the position we have, the scalability that's in our platform. We brought the biggest investors in the world into Matterport because they see the opportunity as well. And then second is, it's a huge global market. And, we've become a bit of a household name here in North America, but that's fast becoming true in Europe and now Asia as well. And so we're really going to be investing in scaling this model that we've been proving out for the last 10 years.
RJ, in terms of what the customer, what people want over in Europe and in Asia compared to what they want here in the US, I guess, how does that differ?
Yeah, the interesting thing is, buildings are buildings, whatever country they're in, we digitize them the same way. The market demands, one of the things we heard a few years ago is they wanted simplicity. They wanted easier access to this technology, which generally is pretty sophisticated. And so about 2 years ago, we started working on a strategy to democratize 3D capture, make it as easy to create that 3D digital twin as it is to take a photo with the iPhone in your pocket. And in fact, we launched Matterport for iPhone. It was a breakthrough technology experience in May of 2020, and it was extraordinary. We 20x'd the customer base of Matterport in less than 18 months, and the uptake from there has just gone exponential.
RJ, there's nothing more aggravating than the real estate companies that say, take a tour, and then it's just a series of still pictures that slide by. Where is the greatest potential growth here? Is it the commercial side, or is it the private, the household side? People like us who might want to just look at real estate because we want a bigger plate.
That's right. So let's remember, residential real estate is $160 trillion of that $230 trillion asset class. So that's always going to be a very exciting market for us, and it should be a big part of the business. But the fastest growing part of Matterport today is the enterprise. I mentioned we took out 13% of the Fortune 1000 shortly after launching Matterport for iPhone, because what that tool represents is a very easy try before you buy. And so we have corporations doing space planning, construction planning, and large-scale facilities management. So we have retailers with literally tens of thousands of physical locations, and they're moving to virtual facilities management, very much like Zoom has virtualized communications in the enterprise. This is a game changer. And there is a lot of square footage, for example, of retail space, and we've made it so easy to do this at scale now.
RJ, we appreciate your being here. The ticker, by the way, so people can check it out, is MTTR. RJ Pittman is CEO of Matterport. Congratulations on going public.